Hey guys, what's going on? So today we're going to be going over money management. So money management is the basis of how to preserve your capital or capital preservation, right? So when we're preserving our capital, this is saving our profits, limiting our losses. This is basically how to keep all the money that we make when we are trading and that so we don't lose it in giving it back to the market. So whatever profits we make, we want to keep it, bank that stuff. Don't want to lose it back in the markets. This is how we're going to preserve that capital or capital preservation. Okay. Now, what is risk management? Risk management is the basis of preserving your capital, limitation towards losses, and creating protection towards profits. This will include a plan that will go along with whatever strategy you have with your trading plan. Risk management is one of the pillars that will form a solid, well rounded trader that is needed to be mastered to become profitable in the dangerous waters of the market. So, risk management is the basis of preserving your capital. What does that mean? This is the foundation of how to keep your profits, how to keep your money. So, what's the point of making more money if you can't even keep your own money? Correct? So, this is preserving your money, preserving your capital, preserving your profits. Limitation towards losses. What does this mean? This means we want to prevent bigger losses from forming. We want to prevent more losses from forming. So how do we do that without risk management? We need to prevent more losses and we need to prevent bigger losses. And finally, and creating protection towards profits. So the same thing as preserving your capital. We want to protect whatever money that we make from the markets, and we want to protect whatever money we already made from the markets. Okay? And this will include a plan that will go along with whatever strategy you have with your trading plan. So whatever trading strategy that we are going to be going over in this mentorship, you are going to put that along with this risk management plan that we are going to be going over in today's video. Okay? Risk management is one of the pillars that will form a solid, well-rounded trader that is needed to be mastered to become profitable in the dangerous waters of the market. So, if you lose a trade in the market, whatever money you put at risk in that trade, right? If you lose that trade, that's going into the market. That is going to become liquidity in the market. Okay? You aren't getting that money back. It's not going anywhere except in that market. But you are not getting it back until you win another trade. Once you win that next trade, that's when you can get your money back. But until then, that money is staying in that market until you win another trade. Let's say you lose another trade. Those losses go into the market as well. So the more money you lose in that market, you aren't getting it back. That's why we need a risk management plan. Okay? Now, what are the different concepts of risk management? So, concepts vary from one to another, but the concepts needed in your plan should include number one, risk to reward ratio or RR, win rate percentage, number of trades per day, percent of account at risk per trade, win streak resets, which is optional, but I do recommend that you guys put this inside your plan, losing streak management, leverage per trade. And these are all the concepts that you will need to understand inside of risk management. So first, we're going to be going over risk to reward ratio, or RR. So RR is the percent of money you are willing to risk if you lose compared to the percentage of reward if you win the trade. So for example, if you have a $5,000 trading account and you are risking $50 to then in return make $150, if you win the trade, you then have a 1 to 3 risk to reward ratio, as in 1% of $5,000 is $50 and 3% of $5,000 is $150. So you are risking 1% to make 3%. Okay? So if you have a $5,000 trading account and you are willing to risk 1% of that trade, that means you are willing to risk $50 to make 3% of the account, which is $150. So you are risking $50 in that trade to potentially make $150 in that trade. Okay? So when you have a higher reward than a higher risk, that is your pretty much what you're aiming for. You want a higher risk to reward ratio. Okay? So the more higher the risk to reward ratio is, the higher your profits will be compared to if you lost the trade. So let's say you had a 1-to-1 risk to reward ratio. You're risking 1% to make 1%. For this, you will be losing the same amount of money as if you were to win the trade. So if you lost the trade, you would have made the same amount of money as if you won the trade. But let's say you win this trade with a 1-to-3. You have 3 times the amount of risk towards your reward. So let's say you lose one trade at a 1-to-3, but then you win one trade to a 1-to-3. That 1-to-3 trade that you won will overtake that 1-to-1. Okay? The reason for this is because 3% is bigger than 1%. You make 3%, you lose 1%. What are you left with in total? 2%. 2% in profit. So your goal is to always have a bigger reward than risk, or a bigger reward to risk ratio, or RR, correct? So you always want to have a bigger risk to reward ratio. So the lower the risk to reward, the smaller the profits will be. The bigger risk to reward, the bigger the profits will be. And you want to minimize your risk as much as possible. That's why you want to have bigger reward than risk. Okay? Win rate percentage. Win rate percentage is how often or how much on average you are profiting on trades on a daily, weekly, monthly, and or yearly basis. So for example, on a basis of 10 trading days, if you win a trade 5 of those days, and on the other 5 of the days you either have a losing day or a break-even day, you will then have an averaged out on a 50% win rate on a basis of 10 days. So on a basis of 10 days, 10 trading days, if you win 5 of those days, and on the other 5 of those days you either break even, which is basically you make no money on that day, or you lose a trade on that day, you are at a 50% win rate. Now, when we compare win rate with risk to reward ratio, these are the two bases of how to preserve your capital and to limit losses. These are the two foundations, the two most important ones. So win rate percentage, the higher your win rate percentage is, the lower your risk to reward can be. But let's say you have a lower win rate percentage, your risk to reward is going to be higher. The reason for that is because you're going to be losing more trades than you are winning trades. So if you're going to be losing more trades than you are winning trades, your winning trades are going to have to be bigger than your losing trades, basically. That is so you can average out in profit. So again, if you have a bigger risk to reward ratio, your win rate percentage can be lower. If you have a bigger win rate percentage, your risk to reward can be lower. But your goal is to have a high win rate percentage and a high risk to reward ratio. These two combined will make you very profitable in the markets with this risk management plan or money management plan, okay? Now, number of trades per day. The number of trades per day will dictate how many trades you will trade at maximum every single day. The rule of thumb is you want to trade at least 1 to 2 trades a day. And at maximum, and I would not recommend trading this many times, but if you really did have to, I would say maximum take 3 trades per day. Now, a lot of these influencers, when you join their discords or you go on their lives, they'll be taking 4, 5, 6 trades a day. Now, that may be how they trade, but me personally, and I can say anyone who is smart with their risk management plan should not be taking more than 3 trades per day. Let alone, I really recommend not even taking 3 trades per day at least either. I'd recommend 1 to 2 trades a day and maximum 3. Now, if you win your first trade, you are done for the day. You are not trading again, you are done for the day. If you lose your first trade, find a re-entry for a second trade to finish the day with a win or break even. This is so that you can end with being in profit for the day and or making no money for the day. Because making no money is better than losing money. At most, if you lose your first 2 trades, find a final 3rd trade, but I will still recommend you stopping at 2 trades for the day. Once you get to that 3rd trade, you are pretty much digging yourself a hole. Let's say you're in drawdown on that 2nd trade. You find a 3rd trade and you lose that 3rd trade. You're in a bigger drawdown hole than you would be if you just stopped at that 2nd trade, okay? So, I need you guys to listen to yourselves and find what is best for you. For me, I recommend you guys would stop at 2 trades, okay? But if you have to go to 3 trades, then go for it. And that is going to be on you That is your responsibility, and you should not and you will not blame anybody else but yourself for that. So if you lose those first two trades, you trade a third time and you take a third loss, and you just got into deeper drawdown, do not blame me. Do not blame your parents. Do not blame your friends. Do not blame anybody. Don't blame your girlfriend, your boyfriend. Don't blame anybody else but yourself. The moment you start blaming other people, that's when you are going to be failing as a trader. This is an individual type of career. You are on your own. Nobody else will help you. This is going to be your own decision-making process, and this is your own responsibility. The moment you blame somebody else, you are starting to dig your hole into being non-independent. Okay? So again, I would stop at maximum 2 trades, but if you have to do the third, do it. Okay? Percent of account at risk. This will represent how much percent of your account you are putting at risk to be lost in the current trade you enter in on. Rule of thumb, risk 1 to 2% of your account at most per trade. If you have a $5,000 account and you risk 1% of your account, you are risking $50 to be lost. If you have a $5,000 account and you're risking 5% of your account, you are risking $250 to be lost. So this will represent along with your risk to reward ratio. So if you're risking 1% of your account, you are risking $50. So if you have a 1 to 3 risk to reward ratio, you're risking $50 to make $150. But let's say you had a risk to reward ratio and your risk is 5%. That means you're basically having a 5, if you multiply 5 into a 1 to 3 to risk to reward ratio, you're risking 5% to make 15%. So you're risking $250 in that 5%, which would be the 1%. So if you're doing risking 5% in a 1 to 3 risk to reward ratio, you are technically risking 5% to make 15%, which is not smart at all. But this is just hypothetically. Okay? So, percent of your account at risk is how much money you are going to be risking per trade, which is going to be the percentage of your account. Okay? Leverage. Leverage is how much more size you are adding or planning to add to a trade entry or current trade entry. This will determine the percentage of your account you will be losing if you hit your hard stops, other known as stop losses. Okay? So leverage is how much money you are putting onto that trade. The more money you put onto that trade, the higher the leverage is. Okay? So let's say you were risking 1%. That's very smart. You start adding more leverage, you go up to 2%, 3%, 4%. You're adding higher leverage. The higher leverage you add, it is a double-edged sword. Yes, you can make more money, but at the same time, you can lose more money. So if you hit stop losses on a 1% leverage, you are risking 1%. You hit stops, you lose 1% of your account. You up the leverage to 4%. You are risking 4% to make 8% maybe. Yes, you can make 8% compared to making 2% if you risk 1%. But if you are risking 4%, if you lose that trade, you are losing 4% also. So it is a double-edged sword. That's why I recommend keeping your leverage between maximum 1 to 2% per trade. Okay. Win streak management. Managing your win streaks will prevent you from losing a bigger number of capital that you would possibly encounter in the future. Example, if you win 5 days in a row and every time you traded, you had traded starting at risking 0.5% of your account per trade and eventually built up to risking 2% of your account per trade on your 5th day win streak. Once you encounter your 6th trading day, you will reset your leverage back to trading at 0.5% risk per trade because a losing trade is bound to inevitably about to come. So what this means is losing streaks will come. It is impossible, and I would say impossible, to have a 100% win streak every single day for your whole life. That's impossible. There will be a day where you will lose a trade, and it's inevitable to come. Once you start building up that win streak, one of these days you're going to hit stop losses. And then when you do, since you've been so used to hitting wins, once you hit that stop loss, you have inevitability to lose that money. And you will eventually, one of these days, go down a thing called a rabbit hole. Now this rabbit hole consists of multiple things. You hit stop loss on one of your trades, you enter another trade. Enter another trade, you hit stop loss again, enter another trade, and so forth. You keep digging yourself bigger and bigger drawdown, losing whatever profits that you had. Also, you keep upping the risk. That's why when you manage your win streak management, once you get those 5 winning streak days in a row, you lower your risk because you know you're going to hit stop loss soon. And when you lose that trade, you don't want to be losing 2% of your account. You'd rather be losing 0.5% of your account rather than 2%. This is managing your profits. This is, managing your capital. This is preventing your capital being lost. Once you lose that trade at 0.5% risk, you can lower your risk again so you don't lose as much money again. Okay, so managing your win streaks. Once you get to the maximum leverage of 2% of your account that you're going to be risking per trade, on that 6th day that you trade, lower your risk back to 0.5%. So the lowest risk possible. Okay? Losing streak management. Managing your losing streak will be the foundation of preserving your capital, as in every time you lose a trade, you will have a plan to deal with those losses. The rule of thumb for this is every losing trade, lower your leverage or risk percentage per trade by 50% until you get to the lowest leverage possible. For example, if you risk 1% and you lose, you risk 0.5% on your next trade. If you lose that trade, you risk 0.25% on your next trade. And if you lose that trade, you risk 0.125% of your next trade. Every time you double your profits or risk to reward, you will double the risk or you double the leverage again. Okay. So what do I mean by this? So let's say you start off by risking 1% of your account. If you lose that trade and you go down to 0.5% on your next trade. If you lose 0.5%, you risk 0.25% on your next trade. If you lose 0.25%, then you will risk 0.125% on your final trade. This will be your lowest leverage possible. And what do I mean by double your profits, you double the risk? If you are on your lowest leverage, which is 0.125%, if you can make a 1-to-2 risk to reward ratio, that means your profits are double your risk, right? So if you're risking 0.125%, if you double your profits, that means you are gaining 0.25%. Once you double your profits, you can up the risk again on your next trade, going to 0.25%. You double those profits on 1-to-2, that means you are gaining a 0.5%. That means you can up your risk to 0.5%. You double that again to a 1-to-2, that means you're gaining 1% on that trade. That means you can up your risk to 1% again. And then once you get back to 1%, every time you get a 1-to-2, you are gaining 2% of your account. Okay? So this is what I mean by your losing streak management. Every time you lose a trade, you cut your risk by 50%. Every time you win a trade, then you up your risk by 50%. So it's back and forth, managing your risk. But because your reward is always going to be higher than your risk, this will in return gain you an advantage of preserving your capital and limiting your losses. Okay? This is something that a lot of traders don't pay attention to. A lot of traders, what they'll do is risk the same percentage on every trade. But if their win streak is low or their win percentage is low, then that's not going to be good for them. And if their risk to reward isn't good, that will inevitably put them into drawdown and you will not be profitable in that sense. Okay. Now, this is the Pip Catcher's risk management plan. And this is a $5,000 trading account example. Or a $5,000 funded risk management plan, okay? So, you will be taking 2 trades a day maximum, okay? Now, you'll be aiming to at least get a 1-to-2 risk to reward ratio, which is you will be risking $50 to make $100, okay? Now, 50% or more for a 1-to-1 risk to reward ratio, okay? I want you to look at this. Pay attention to it. Observe it, okay? Now, your maximum risk per trade will be 1%, which is $50. You will not go above 1%. 1% will be maximum. You will not go over it, okay? After every loss, I want you to cut 50% of your risk. So, if you are risking 1%, which is $50, if you lose that trade, I want you to risk 0.5% on every trade, which would be $25. You lose that trade, I want you to cut your risk again to 0.25%, which is $12.50. If you lose that trade, I want you to cut your risk down to 0.125%, which is $6.25. If you lose that trade, I want you to cut your risk even further down to 0.0625%, which is $3.13, which will be the lowest amount of risk that you will be using until you are able to double your profits again with a 1-to-2 risk to reward ratio. Okay? Using this risk management plan, once you can double your profits again, you double the risk, which means if you are at $3.13, you get a 1-to-2 risk to reward ratio. You are gaining $6.25, which means in that sense you can you can double your risk again. So on your next trade, instead of risking 0.0625%, you can risk 0.125%. You double your profits on that, you can risk 0.25%. Double your profits on that, you can risk 0.5%. Double your profits on that, you can risk 1% again. So every loss, you cut your risk by 50%. Every win, you basically double your risk. So every loss, you cut your risk by 50%. Every win, you double the risk on your next trade. Okay? Using this risk management plan, in total, you can have a total of 133 losing trades in a row until you blow your account, until you blow your funded account, until you fail the funded account, until you fail the funded challenge. Okay? So in doing this, if you have a $5,000 funded account and your drawdown rule is 10%, right? You can trade 133 times and lose 133 times in a row using this risk management plan without failing this trade. Okay? Now let's say you risked 1% on each trade. You would have a total of 10 trades that you would trade until you lose the challenge. Using this risk management plan, you can lose a total of 133 times before you lose the challenge. Okay? So I recommend you guys use this can't speak today. I recommend you guys use this risk management plan and you stick to it. Okay? Now yes, one or two of these days you might not stick to it, but overall I want you guys to stick to this. If you guys can stick to this, this will be the plan that you are able to use for pretty much any funded account, any live account. You guys can use this for any price of an account, a $5,000 account, $500 account, $500,000 account. You can use this risk management plan. This is the most basic but most safeguarded plan that I have created for you guys. And this is risk management, preserving your capital. And it is important you apply this to your trading. Okay? Now, a lot of these traders out here, they'll be telling you to risk 2% per trade, 3%, 4%, But your goal is to preserve your capital. Your goal is to make more money than you do losing money. And what's the point of making more money than you are losing money if you're losing a lot of money, right? So, your goal is to lose as less money as possible and to make as much money as possible, with the parameters of not being greedy and with the parameters of being smart. The moment you aren't smart about this, the moment you aren't being smart and you are being greedy, that's when you will start losing more money than you will be making money. Okay? And this comes with psychology as well. This is only the statistics of this plan, but this will become psychology. Your goal right now is to follow the percentages. You want to make based off percentage. You don't want to look at your P&L. P&L is profit and loss. You don't want to look at how much money you are making or losing. You want to pay attention to the percentage of money you are making or losing. Okay? Focus on the process. Focus on the percentage. Do not focus on the money. The moment you focus on the money, you will get attached to the money. The moment you get attached to the money, you will not be able to separate yourself from it. Okay? And it's going to be hard to separate yourself from it. You need to focus on the trading process and not focus on the P&L. The moment you are focused on P&L, that is the moment that you are going to be losing a lot of money. Okay? You cannot be focused on trading P&L. You should be focused on trading solid setups, and you should be trading based off of your risk management plan. Okay? Now, if you guys are listening, I wanted you guys to look this over Watch the video again if you need to. But take a picture of this or write this down in your journal. Okay? You guys should be taking notes. Okay? So, on the next video of the mentorship, I'm going to be showing you guys, starting to develop you guys into learning these concepts. But this is the basis of how you are going to be profitable in the markets, which is your risk management plan. Without this, there's no point in trading. If you don't have this, you are gambling. Day trading is not gambling. If anything, it is professional gambling. It is measuring out the probabilities. Okay? It's measuring out the probabilities of winning the trade. Without this as well, you are inevitable to be less profitable. You are inevitable to be drawn on. And you are inevitable to not be smart enough to be trading correctly. And you are known as a gambler. You are gambling your money. Now, whenever people are going to be bringing up day trading and somebody asks, what do you do for a living? Oh, I'm a day trader. They're going to shit on you. They're going to shit on you, and they're going to shit on you hard. And I'm not even fucking playing with you. They're going to fucking shit on your fucking face. Right there and then. Or what they're going to do is they're going to act like they're smarter than you. They're going to try to teach you some shit. But everything I'm going to teach you in this mentorship, you can blow their fucking minds out of the fucking water. And you're going to look at them like they're fucking stupid. They don't know what algorithm is. They don't know how this algorithm of the market works. The market runs on an algorithm, on the basis of market makers supplying the liquidity funds. The market maker is making that manual intervention. They're making the moves. They're just following what the algorithm does, though. You don't understand price action. Price action runs on an algorithm. And all these retail traders that trade support and resistance, fucking Bollinger Band, RSI bullshit, it doesn't work. Why? Because it's delayed. If you need a delayed indicator to tell you when to buy or sell, you don't know what you're doing. You're gambling. If you're able to read candlesticks and pure price action at present time, you know what the fuck you're doing. But people aren't going to admit this, but 99% of traders are stupid. 99% of retail traders are stupid. They don't know what they're doing. They may front and act like they know what they're doing, that they're better than every other trader, but they don't know what they're doing. So in this mentorship, I am going to be teaching you ICT concepts, smart money concepts. And this is going to be about how the algorithm works. And this is how you trade. This is the correct way to trade. Now, I'm not saying you can't be profitable trading all these other strategies like retail, using indicators. But what I am telling you is that they aren't trading based off of market algorithm. Now, yes, maybe like 3 out of 10 times it may line up correctly. But I'm not saying that that's the correct way to trade. Okay? I will be showing you guys and teaching you guys these concepts and how to apply it in the real life markets. The live markets, I will show you. And on top of that, you'll be combining your risk management plan with it. Okay? Now, in the next video, we are going to be starting to add in concepts. And you're going to be needing your journal for this next one. And on top of this, I am going to be expecting you guys to individually, on your own, independently, be doing your homework on the live markets. Watching it in the live markets. Okay? In the live markets, you're going to be doing a thing called tape reading. Tape reading is where you look at the markets, identify different concepts that I teach you in the markets, spot it with your own eye. The more you do this on your own, the more you can spot it instantaneously. Right when you look at the market, it, boom, pops out right at you. The more you do this, you will get it. Okay? Other than that, I hope you guys have a good rest of your day, and make sure you be ready for the next one.